Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is a big day. It is June the 14th, 2023. We had the announcement from the Federal Reserve today saying that they are not going to increase the federal funds rate for the first time in 10 consecutive increases. They're not increasing the federal funds rate. But we need to look a little bit further into the report because the markets really did not like this when it came out. The bond market was not happy. We'll have to see how it ended for the day and how that affected home loan interest rates. Now, before I do that, I want to make a point. We always hear, and you're going to hear on the news today, that the Federal Reserve does not increase the federal funds rate. They're going to say, oh, yeah, this is great news. That does not mean that home loan interest rates did not go up or did not go down. Home loan interest rates are influenced by the movements of the Federal Reserve because they tie into inflation, and inflation is the enemy of mortgage backed securities and bonds. So, home loan interest rates could have gone up today, could have gone down today, even though the Federal Reserve left the federal funds rate unchanged. And that's going to be the news that you hear today. Federal Reserve leaves the federal funds rate unchanged. That will be the exact term. And then they will talk about that they paused. Pause is the big word. So after we get the announcement from the Federal Reserve, the market, of course, is the highest priority to them is what they actually did with the federal funds rate. After that, there is an interview with the chairman of the Federal Reserve Board, Jerome Powell, and they see kind of a little bit more about what the Federal Reserve Board is thinking. They ask questions and get comments and banter back and forth because they want to get a little bit deeper into the heads of those Federal Reserve members. And what they want to know is, okay, so you paused. Now, the word pause, you got to understand, you got to always dig deep into this because if they would have said, okay, we're stopping increases to the federal funds rate, well, they did, right? I mean, they didn't increase the federal funds rate. But is it a stop? Is it a pause? Is it a breath? Is it a moment? That's what they're looking for. And the Fed sits there and they really pore over the exact word that they want to use because the market looks so deeply into those comments, and that's how they actually move. So the pause to the federal funds rate was kind of highly anticipated, so probably already baked into the markets, but they wanted to hear what Jerome Powell said. He used the word pause. Now, pause, when you think about it, it really kind of makes you think, well, then they're going to continue later, right? I mean, they didn't stop. This is a pause, which would make you believe that they're going to increase the federal funds rate more in the future or bring it down. It's just a pause. You don't really know what that means. And the reason that they use the word pause is because they're trying to let the markets know that they may increase the federal funds rate in the future based on the reports that they get from all their inflation data. And if they said stop, and then they had to increase it later, then they look foolish. So this way they said, look, we're going to pause, which means, and what again, looking further into this, which means that they do see inflation coming down and they do see positive effects from the increases to the federal funds rate that they have already done. The work that they have already done is filtering into the economy. But they said, look, we're still not where we want to be. So we're going to pause. And then they actually have a survey basically that each member of the Federal Reserve Board puts together. And that's called the dot plot. And that basically, at the end of the day, what it is what do you think is going to happen in the future? Each one of them. And most of them said they think they see increases to the federal funds rate 2 additional times during the year of 2023. Now, once again, they have to put that together to make the markets know that they're serious about bringing inflation down. If the reports come out over the next month, really 6 weeks, in July is when they will meet again, showing that the federal funds rate, showing that inflation is coming down, PCE, CPI, PPI, employment numbers are all where we want to be, then they will continue to pause on the increases or reductions in the federal funds rate. They will continue to pause because that allows them to keep the door open for movement one way or the other without looking foolish. If they bring the federal funds rate down, they go, "Yep, it's ready. It's time. We did the right move." If they have to bring the federal funds rate up later, they say, "Well, we mentioned that this was only a pause." You see, it's all about wordsmithing in that case. So how does the market respond? Now, first of all, I'm going to put a link in the comments below to this report that came out. The Fed holds off on hiking rates, but says two more are coming later this year. Now, I would question Mr. Jeff Cox, who wrote this, as to whether they said two more hikes are coming. Now that's pretty definitive. And I would say that that is not what they said. They said it may. They said depending on the data that they receive. So Jeff Cox made a pretty bold move right there, writing in his paper that they two more are coming. You see how it really matters which words you use. The markets would have gone a little different if they said there two more are coming. They said may coming. We may see that in the future. So this, again, this whole article with a lot of detail as to what was in the Federal Reserve Board and Jerome Powell's comments is going to be coming to you in the comments on the email below. Let's take a look where the markets are now. It is currently 4:28 p.m. Central Time. The markets are closed. The bond market is closed. Mortgage-backed securities are no longer trading. And earlier today, when the news came out, the bond market went and dropped 35 basis points. We were down 35 on the MBS, the mortgage-backed securities that we follow on the 5.5 coupon. Right now, we're up 5. So throughout the day, as we always talk about, there was a knee-jerk reaction, and the markets went, oh no, and they went way down when they started talking hawkishly about increasing the federal funds rate in the future, down 35. But as the markets digested this information and looked further into it and got more information, they slowly, and I watched throughout the day as the MBS slowly climbed back up and ended in positive territory here, now up 5. And again, if you watch this channel only, if you're new to this channel, you should know when the mortgage-backed security goes up, interest rates go down. Okay, so we want this to be green. We want this to go up. That brings interest rates down. The 10-year treasury we want to go down because this is a yield measurement and it's down 4. So both of these are what we wanted to see for the day, but pretty darn flat. Here we are, the charts right here. You can see that we dropped way down below the Fibonacci level at 99.44. We climbed back above the 99.845 and ended the day just below, kind of allowing the Fibonacci level at 99.845 to be our ceiling for the day. Where are home loan interest rates after this news? Let's go ahead and run the scenario for the Brent Bruce Daily, the very well qualified 30-year fixed conventional home loan, 800 FICO score, 25% down, owner occupied, that we look at each day, the very well qualified client. Right now, the Loan Store is leading the pack at 7.0% with a little bit of a credit, $320. Now, this is kind of interesting to me that they would be at 7.0 with a credit of 320 instead of finding a way to be able to offer a 6.999 with maybe no credit. The 6.875 is only costing 238. So you know there's room. There's room in there for them to have been able to give us a 6.999 handle, a 6 handle. When I say a 6 handle means it starts with a 6. If I say 5.999, that's a 5 handle. 5.25 is a 5 handle. 6.25 is a 6 handle. Right now they're giving us a 7 handle. And do you want to hear 7.0 or do you want to hear 6.999? You want to hear 6.999, even though your mortgage payment only went down $1.50 a month, you still want to hear 6.999. So let's take a look and see what else the other banks are doing. Again, the Loan Store has been leading the charge for a while since they just purchased Home Point, and they want to stay in the front of the pack with their wholesale partners like I am. We always look at United Wholesale. United Wholesale is the largest wholesale lender in the United States. So right now, 6.999 for them is costing a little bit of a cost, $994. Let's open this up here and see a little bit more. If you wanted to say absolutely no points at all, they're at 7.375. Pretty rough right now with United Wholesale. But again, for only $994, we're at 6.999. If we wanted to get to our 5 handle, 5.999 is costing 2.416. So almost 2.5 points. Let's take a look over here and modify the search here and show you the parameters for the Brent Bruce Daily that we take a look at each day. So once again, the Federal Reserve leaves the federal funds rate alone. What does that tell us? Last point. It tells us that the Fed saw inflation go up, 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 and then they had to raise the federal funds rate to chase it and try to push it down. But we know that inflation is coming down based on all the reports and charts that we've been watching. And then now we see the Fed starting to do this. All right, let's pause. Let's stay about here. And hopefully they start to taper off on the other side later in the year. But they sure talked hawkish today, saying that potentially having two additional increases to the federal funds rate during this year, September, I think it was July and September that they were talking about it. I think they were just leaving the window open. I think we're going to get reports that allow them to keep the federal funds rate alone and maybe pause it another time here in July as they see the effects continue to set in. We will see. Let me know what you think. Make sure that you like, subscribe, share, hit the notifications bell up in the top corner so you always get notified. I will talk to you again tomorrow and see how the markets continue to digest this big news. Talk to you then.